Hello, everyone, and welcome back to our weekly session of TradeFinder. Some of you might know me. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'm going to be facilitating this session tonight with Mr. Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I will introduce Rob, and we'll get to the good stuff that we're all here for. So first and foremost is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States. So nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. So again, most of us out there are likely familiar with the Q&A process. When Rob gets through his presentation, he'll open it up to Q&A with the time remaining in the hour session. So if you are unfamiliar or new to this session, welcome. We're happy to have you on board. Please take a moment to review the slide that you see there to get familiar with that Q&A process. And in that meantime, I think that wraps up all of the housekeeping details. My personal curiosity is on what Rob's thoughts are. The market continued to consolidate the gains that from last week's JOLTS report, and the interest rates are heading back up. So I'm interested to hear what Rob thinks of all that. What exactly does that mean? Where are we headed from here? Very excited to interact with you all, and thank you for joining us for this live session. So at this moment in time, I'll introduce the man of the hour, Mr. Rob Roy.
Thanks, Zach. Glad to be back in the Dragon capsule, as people will be able to see here momentarily. And you had a lot of questions there, but I did want to bring up something as far as things that we don't see. We see rocket launches, stuff like that here on the Space Coast, but don't see that. And that was literally right out the window of the cabin, less than 20 yards away. A nice buck there for those of you that are wildlife fans, and then joined by another group of deer. So different sights that you see when you move to different areas. And luckily, coming back here to the Dragon capsule in Florida, it's not quite as hot as it was when I left. So I hope that means that we might be past all that record heat and heat indexes that we had just a couple weeks ago. Perhaps the storm blew all that out. I don't know, but it's definitely nicer here than when I left. But it's good to be back and taking a look at the market. You ask a lot of questions, Zach, and you're right. The market is still consolidating. In fact, we are exactly right back where we were on the 30th of August, the 29th of August, when the JOLTS report came out. And again, as a reminder for those of you that may not have been here last week, that's a job openings and labor transfer report. And basically it's people moving jobs. Usually you leave one job to go to another job to get a raise because somebody wants to pay you more. And all the headhunters that come after people, especially when we have a jobs market like this, where there are fewer qualified people than job openings. And so people offer you incentives to leave. And that all goes into wage inflation, which creates an overall higher inflation number, which is one of the things that the Fed has said they really want to get rid of, even though they don't want to crush the jobs market, but they do want to lessen the job inflation created from wages. And so I guess that was viewed as a reason for the market to move higher. So we had that big move up and then nothing since then. We kind of drifted up and drifted back down, and we're right exactly where we were on that day. We're still a tiny bit above the 10-day moving average. So the fact that we've gone sideways and actually pulled back, I think is normal. I don't think that means anything as far as whether or not we can continue higher from here, or if we're just going to make a lower high and roll over. So we've got a couple of interesting things to look at when we take a look at what happened with this wave 4, awfully close to the 38.2% fib level. So we had a pivot point there, and then we had another pivot point here that occurred on the 25th. So you look at those and you can draw a bit of a trend line there, and that's what we've been moving off of so far. If we do roll over in the market, we got to break back below those moving averages, and then you could start to say, well, maybe we have a downtrend line. So it's not really a triangle pattern, but when you combine the pivot points on both sides, it looks like maybe that's what's going to happen. So perhaps we have a little more consolidation before we make a move one direction or the other. But I wouldn't say that the bullish thesis that appeared is over, and I wouldn't say that market's rolling over. So we're just going to have to wait a couple of days and let the market tell us. If you're wanting to go long and you're more on the conservative side of things, you would want to see the market break above this wave 3 high with the 460 level. Then the algorithm will label that move as the wave 5, and then we have a run likely up to the 480 level. We're also moving into September, which is historically the worst performing month. Again, nothing's 100%. That doesn't mean that this September will be a bad month for the market. But historically, when you go back and you look over the number of months, September has not been a great month for the market. So lots of things to take into account. I still think we're kind of in that stock pickers mode here. But if we do break above 460, I think you see some short covering. And I do think we run up and hit that 480 level, but we have to get above 460 first. Moving back down, if we take out this wave 4, I still think you have to have at least a tiny bit of thought in the back of your mind of the possibility of testing that 420 level, because it was such an important level before, and we didn't really give it a solid test. When we broke above it, we just kind of took off, and I think that's still a possibility. And if you look at where the wave 4 is and you kind of just eyeball it, I would think that's probably pretty close to a 61.8% corrective move if the market were to come down there towards 420. So we're way away from that. So certainly not saying that that's going to happen, just a possibility to keep in mind. But we want to see how we handle this 10-day moving average first. And so far as this moment right now, and that's all we can do with technical analysis, is analyze the data that we have at that given moment. You still have to look at this as a bullish move to the upside. But if you're just wanting to be a little more conservative, as I said, wait for it to break above 460. If you're long now, no reason to get out unless we break back down below those major moving averages. Then I think you might want to take a bullish position off. But if you're aggressive and you're long right now, no harm, no foul yet. And perhaps we get that break above 460 and take off and run. We had one of the more hawkish Fed governors didn't take the November rate hike that's being priced in off the table, but was a tiny bit more dovish this morning than where he's been as far as one of the bigger hawks on the FOMC. And he, that was given a lot of fodder on the financial networks this morning. If one of the more hawkish Fed governors is kind of sounding slightly more dovish, then that could be more case for the market to move to the upside. When we look at volume, you can see how volume is just dried up, and you would want to see more volume on the move to the upside. We did have decent volume here on this 25th of August, but since then have drifted down. We did have average volume on the big update with the JOLTS report, but it wasn't significant. And since then, volume's dried up, but the market's gone sideways. And that's usually what happens when the market consolidates, volume dries up. So I wouldn't look at that as a negative or a bearish sign yet. What I would think, just to wrap this up on the S&P as a bearish sign, is if we break back below those major moving averages. So for now, all we're doing is giving back a little bit of backing and filling from that big move up, the big update on that JOLTS report. So this is to be expected, I guess, is what I'm trying to say. I wouldn't read this as being bearish from the move off of that pivot point low on the 18th. This is what I think is driving things, is interest rates. We had the move down, and that gave us the move back to the upside on the JOLTS report. But the past 2 days, interest rates have turned and headed back to the upside, and we only had a 28% wave 4 correction there. It did label it because it went past that 23.6% level. But as you know, if you've been listening, Elliott himself wasn't a huge believer. I mean, he acknowledged it because it's a fib level, and that's how he wrote his algorithm. But in his notes and musings from his observations and guidelines, he preferred a corrective move down to that 38.2% level to feel more comfortable that that was indeed a correction. So the fact that we're sprinting back to the upside, there's a possibility that this is still more impulsive than corrective on this move to the upside with interest rates. And that's not going to be good for the market to see rates jumping back up like that. So we'll see if looking at the 10-day moving average, even with that move up, we're not that much overbought on rates. So rates could go higher from here is what I'm trying to say. And if we were to take out this wave 3 high on rates and start to move towards that wave 5 target, that's going to be a difficult environment for the market to continue to move higher from, and getting above that 460 level would be a lot more difficult if rates continue back to the upside. And then come back to, so the trouble things that we had that kind of took a break for just a few days, but it was enough to give the market a bounce to the upside, are coming back. So the dollar is rallying again. Why is that going on? There's something that we don't know about yet, and I think it's a global phenomenon that's occurring. And so perhaps there's more weakness globally than what we are aware of, or what has shown itself in the data yet. But people are piling into the dollar, at least over the last couple of days, and that's not going to be positive for the market either, with all the international companies and exchange rates, et cetera. It's going to be tough on the next quarter earnings if the dollar continues to run back to the upside. The Elliott Wave toggle there is on, but no labeling. So we are in an impulsive move to the upside here on the dollar, and we'll wait and see when it falls within the algorithm for some sort of a 5-wave pattern. But for now, we're just in a big impulsive move to the upside on the dollar. So the dollar and rates going to the upside, problematic for the market, I would think. Since we're looking at the dollar, and we've been looking at SLV, and it looked like, gosh, we might have missed an entry here when we had this big move to the upside. As the dollar came back a little bit, you can see that the metals are dying for a bid. They want to bid in the worst way, and they tried, and we didn't get in. And now it's okay. Good thing that we didn't. I just don't chase these big gaps and runs. You know how that works. And we've gotten overbought, and so we kind of went a little vertical there. And what goes vertically up, what comes vertically back down, and that's what's going on with silver. So we didn't miss the move, and we'll continue to keep an eye on it. What we are seeing, though, and this is a little bit problematic, is lower highs there on SLV, and perhaps we're doing some sort of consolidation with these lows here and lower highs. Early stages, but maybe we're forming a bit of a descending triangle if we go sideways or churn around within these two trend lines over the next month or so throughout September. So yeah, when it looked like maybe we missed it, we didn't. And that's why you don't chase the vertical moves. A perfect example of why you wait. And even sometimes when it feels like, gosh, we missed it, or we need to get in, look at that big gap up, we're going to take off and run. You follow your rules. And even when it's difficult at times to do that, you still have to stay disciplined and follow them. So we didn't miss anything on the SLV yet. We'll continue to watch the dollar. But gosh, that looks pretty darn strong to me right there, that move to the upside on the dollar. I think we continue higher from here. So before we get to the rest of the markets, let's take a look at the VIX. The VIX came down and literally tapped its toe on 13, And we talked about that last week, and coming back down. Were we going to break this 13 level that it's acted as support? And we didn't, at least not yet. So we touched it. We actually closed on it on September 1st, and we've bounced back to the upside slightly, not much, but slightly on the VIX. And if we break that 13 level, then who knows where we could go from there. And we're holding that really important fib level, 61.8. So once again, 13, at least for the near term, has acted as support on the VIX. So a little bit, tiny bit more volatility, a little bit of a move to the downside, not much, more consolidation than anything. So again, I think we need to see the next couple of days for those of you that are alert subscribers with ewotrader.com. Perhaps we'll have more information in Thursday night's insiders meeting as to whether or not this move continues up in the VIX. If the market continues down, what happens when the 10-day moving average and the S&P come together, because they will. Even if the S&P goes sideways and allows the 10-day moving average to catch up, or if we come back down to it, you go and look and you can see every time we get a little bit away from the 10-day moving average, even slightly, it comes back down and tests that 10-day moving average. And it works the same on the other side. If we're underneath it, we come back up and touch it. So we're above it, we come back and touch it. So that's going to happen again. Just don't know whether it's the market continuing lower or going sideways and allowing that 10-day moving average to catch up. But one of those two scenarios will occur, and we will touch the 10-day moving average likely within the next trading day or two. All right, so now let's take a look at some of our other U.S. markets, the DIA for the diamonds, and just kind of churning here, close just ever so slightly below the 10-day moving average there, right, yeah, awfully close to it. Just call it right on it, because the 10, 30, and 50-day moving averages are all pretty much in the exact same spot. And you want to see if we give up this level here of potential support. We traded below it, but we're able to jump right back above it here in the middle of August. But now it looks like maybe we're going to test that level again. And so if we break below that, the one thing that has not occurred yet with a 75% wave 5 extension, that's less than 100%. So at some point in time, unless we break up and extend that wave 5, the wave 4 will get tested. That's just the way it works. Extremely high percentage of the time that occurs. So we need to keep an eye on where we are right here, and it's just above 345. So we look at the high from the wave 3 going back there, closed at 342, but the high was 345. So looking right in that area, that's what we want, 345.73. So the 345 area is what we want to watch on the DIA. That looks weakish to me, and you can kind of look at this, and if you've been watching, you probably already noticed that looks like a zigzag. And look where the 100% extension is on the zigzag, exactly where the previous wave 4 is. So you can make a case for that. You know, I think the Dow looks slightly more bearish than the SPY does. And then let's take a look at the Qs. I know everybody wants to look at the Qs. That's where all the action has been, and really held in there pretty well. Considering what happened with rates today and the dollar, I think we could have seen a significant down day on the Qs. Didn't happen. So for those of you that are bullish, I think you can rest your laurels there and say, hey, this could have been a really ugly day in the Qs, and it wasn't. But we are right underneath this resistance level again at 380. We tried to break above it, couldn't do it. No follow through on any of these breaks. So we came back down, created another wave 4 that's just right at that 23.6% levels. So we do have to keep an eye on those as not being enough of a correction to feel comfortable that the wave 4 is over. We're in the wave 5. This could go down and make new wave 4s. And that's why I'm highlighting those fib levels and the fact that we haven't seen a 38.2% level. But easy to look at the Qs. If you're long, you're looking at 380. If you're bullish, you're like, yeah, well, we're just consolidating. We got overbought here. We're at resistance. So that makes sense. We're at a resistance level and we're a little tiny bit overbought. So going sideways is good. And just, reiterate it again. Could have been a much uglier day in the Qs than what it was. So I think that was pretty impressive and something that the bulls can be comfortable with. Not so much on the IWM. So if you're a fan of the IWM being small caps as a barometer of risk on, risk off, that wasn't a good day. You can see that we had a pretty significant day down. So a lot different action in the IWM than we had in the SPY, Dow, or the Qs. And we hit that 190 level and got turned back. We tried to break above it yesterday, but no follow through. Not yesterday, Friday. Yesterday was a holiday, but on Friday, and then no follow through today. And back we come below 190, and we just can't seem to get back in that range between 190 and 210. Seems like we want to stay in this 170 to 190 range. I was really surprised here in the middle of August that we got this close without testing 180, but 180 had been tested. That we had that tightened range we've been watching, but we did test it here in June. So it has been tested. So it's not like it had to do it or should have done it. I just was surprised. I just kind of thought coming down this far that we would go ahead and test it again, but we didn't. So the market's going to do what the market's going to do. And it certainly doesn't care what I think, it's going to do. But we have to watch this too, because that wave 5 was 91%. So the same scenario here, if we don't relabel that wave 5 soon, and that's the end of the wave 5, then we need to come back to this previous 4, and look where it is, 180. So maybe I get my test to 180. After all, just not as quick as I thought it might occur. And yes, if you're watching, that does look like another zigzag. And there we go. The 100% extension would bring us down past 180, down to 175, and right in all of this congestion there that occurred in March, April, and May. All that trading right through 175, up and down, a little above, a little below, but right through 175 for basically 3 months in a row. That's where the C wave extension says we could go if we continue lower. So as you can see, a little cautious on the upward move. It's not negated yet, but caution. So I guess we're all the way back to cautious optimism, which was the phrase we were using a while back when we were moving to the upside. So ugly day there on the IWM. You probably would want to look at volume, and that's good solid volume, just right average volume, right on the 200-day moving average. So it wasn't significant volume enough to where you would think, all right, everybody wanted to sell is out and we could turn and move back to the upside. We still could. You need to see that IWM back above 190. That's the key. Hard to be bullish on the IWM below 190, in my opinion. I think it looks bearish. So do we get follow through to the downside on the IWM tomorrow? We could with solid but not significant volume. We could have some follow through back lower there on the IWM. So let's take a look at a few of the international markets that we check each and every week. We'll look at Canada, the EWC for our Canadian friends, and we would have, gosh, if you're bullish, you would have liked to have seen it get back above that 35 level. That's another one of those areas like I was talking about on the IWM at 175 where there's congestion. You can see how much we've traded right through that the 35 level here. We hit it and got turned back, but we are above the 10-day moving average, and we're even closed above the 50-day moving average. So even though this wasn't the greatest bullish day, because we are just correcting overbought conditions, you could just say this isn't just the normal course of the market, and it's going to take more to the downside before we start to take away that bullish optimism. It could happen there's enough to be concerned about, but it hasn't done it yet. So still a touch on the bullish side. Looking at the Aussie market for our friends down under, anxious to see what occurred here with the rates and the dollar. A little bit of a step back, which you would expect because they're so resource rich there. And we have this level of 22 that we're back towards again. It looked awfully ugly when we broke below 22, but it managed to hold it, catch its breath in an area that I didn't think would catch itself. I thought it was scary time here breaking below 22, and you could have been looking at 20 or 19 and a half, but it was able to grab itself and get back above 22. But now we're down testing it again. So we'll be looking at that level in tomorrow's market for the EWA. Can we stay above the 22 level? We are right at the 10-day moving average here. So it needs to hold here and bounce and move back to the upside. We are in a qualified 5-wave to the downside pattern here on the EWA with a 54% wave 4, that's pretty solid. The thing is that from a time standpoint, we're kind of running out of time for that wave 5 to move lower, and it could change and move over. But again, you're looking at 22 on the EWA over the next couple of trading days and see if we can hold that level or if we move away from it. So the INDA for our friends in India, which has been performing so well and continues to perform well. Just amazing, honestly, to see this move here. And we just had that 23.6% wave 4. So again, Elliott would, if he was here, would say, I just don't view that as enough of a correction to say that we're done. But we're moving back to the upside above all the major moving averages. The INDA still looks like the strongest global market to me, and that's pretty impressive considering everything else that's going on. So if you're long the INDA, I think you're in the right place. And if you're looking for money to, spread out, I think globally you want to look at the INDA. And if you're really, really cautious, then hang on and see if we can break above this wave 3 high. So if you're aggressive, I think you can go now. You look at the DMI, the ADX is turning up, but it's still got some work to do. So if you're really aggressive because we're above the major moving averages and moving higher, you could step in. But the more conservative would be wait for that ADX to get above 20, see if this separation between the two directional indicators continues. And if it does, then there's a high likelihood we do break above that wave 3 and go to the wave 5 target. So let's let it do it first. The Missouri thing I talk about in my analogy, show me. But I think if you wanted to be aggressive somewhere, that would be a place. Obviously, energy here. I'm sure we'll be looking at oil and some oil stocks in the questions. And I'm going to show you when you're right and wrong at the same time in our example, our case study example of our alerts that we send out at ewotrader.com. But before we do that, let's take a look at the German market. So the EWG, and we're kind of coming back down. So a couple big down days here on the EWG after running up and testing that 28 level. We broke below it and held ourselves kind of again in no man's land with this big doji, and ran back up, tested a 50-day moving average. Now we're actually a tiny bit oversold with today's move, and we want to see if we take out this wave 3 low and see where we go from here. We haven't labeled that wave 4 yet, even though the high made it right into the tap box. So you wonder why the algorithm hasn't labeled that with the 4 yet. And with that, you have to at least keep a little bit of thought that, maybe we bounce back to the upside again on the EWG, since it hasn't, at least for now, labeled it. Perhaps if we take out this wave 3, that 4 will get labeled. But interesting that we went right to the targeted range, but yet it hasn't, for whatever reason in the algorithm, actually labeled that way for. But a couple of big down days on the EWG, heading back lower. And now we want to see, can we follow through and take out this low from the 25th of August? If so, we're probably going to come down in this area right here, which is exactly where that wave 5 tap box is, and that would be testing these March lows. That seems to make some sense right now. But again, we're a tiny bit oversold today, so even if we get a little bit of a bounce tomorrow, I think to become bullish on the EWG, you got to see it back above 28, especially when you have a qualified 5-way to the downside pattern. So looking okay there. Now, what I wanted to share with you with our case study that we did, this alert that we sent out, this was in our speculative trade. And remember, at evotrader.com, every alert that goes out, and we send you out alerts for entries, any adjustments and exits. We've had tons of great trades on the time strategy, and I can show you a really good one here in a moment. But I did want to show you this because this is what I was talking about when you're right and yet you're wrong at the same time. That's when you earn a profit, but you kind of got out too soon. But we got a over 12% gain in less than 24 hours. And the reason this was sent out was when that storm was in the Gulf, and it was supposed to turn northeast much earlier than it did. So as it was going further north into the Gulf, you get into the danger area of shutting down all those oil rigs that are in the Gulf, off the coast of Louisiana, et cetera. And that certainly could have put a bid under oil. That was the reason for the speculative trade. And so it worked. We had a nice big day to the upside in oil, and we took the trade off. We took that quick gain. And now you look at a chart of USO and you're like, you big dummy. Look at that. Yeah, took that one off a bit too soon. Hard to complain about a 12.5% gain in less than 24 hours. But then you look at that and say, but it could have been more. This is one of the things that we talk about all the time. If you're happy with a gain when you take it, you have to stay happy with it. Otherwise, you'll drive yourself insane. When you look at stuff like that, and OPEC came out and said they're going to keep their production cuts at least through the end of the year, and that put another bid under oil. And so there we go. Right place, got out a little bit too soon, or could have had a massive home run type trade there. And that's kind of a shame, but that's the way things play out from time to time. And so, gosh, yeah, it's tough to look at that when we're on it, we're in it, and then we move up. So now we look at it and we're right at the wave 5 target. So this is a bit vertical on oil. And I think that maybe oil needs to come back to earth a little bit here. This is the stuff I don't like. You can't chase these vertical moves because, again, what goes straight up oftentimes comes straight back down. But boy, did it blow right through that wave 3 high. Didn't see that coming. And that's why we got out just a touch early. But it did. And that's what happened. But we're way overbought now. You can see where the 10-day moving average is. No security in any time frame, gets very far away from the 10-day moving average. So I think oil needs to take a little bit of a breather here and perhaps come back down somewhere near this wave 3 high around 75 on the USO. And then, with the price of oil staying high, all those oil stocks that I'm sure you're going to ask about, so I won't bring any of them up in the Q&A, could certainly benefit from this higher price of oil. So that's where you want to be in the U.S. market, energy, but just be careful because oil has gone so vertical that a little bit of give back is warranted. So perhaps be a little patient on entries if you haven't gotten into the oil stocks yet, unless you can find one that hasn't followed these vertical moves. A lot of them have. and there's no way I'm going to chase that. But I'm certainly interested in the oil companies that are going to benefit from this higher price, even though I feel like we need to come back just a little bit at least from this vertical move to the upside and overbought conditions and hitting this area in the tap box of potential resistance. So we'll save all the rest of it for the Q&A. So for now, let's see if we can find a case study for tonight. Actually, let's look at the other ones first, and then we'll do that. We only have a couple to look at. We already looked at the SPY. So there's only two to look at. So we had Home Depot here that we looked at on the 15th. And you can see we pulled back a bit. We talked about this last week. We made a nice climb to the upside here. And then some give back today. And you look at the 10-day moving average. Didn't like to see it close below that. This is kind of an either or one. If you're aggressive, you could wait and see if we can get back above 330. It was encouraging on Friday that we were back above 330. We could take off and run and have a really nice profitable gain, but we didn't get the follow through. We broke back below it. So I would say on Home Depot, if you're still following this one, if we can't get back above 330 tomorrow, I think perhaps just, just maybe a tiny loss, a little bit of time decay, and close that one out and call it a day. But gosh, it looked good on Friday, and we just couldn't follow it through today. But tomorrow could be a different story. I mean, when we talk Thursday night, we may be looking at Home Depot and see it way back above there, but not now. And then last week we looked at Rock, and what I wrote down in the notes is it needed to close above 75, and we needed that positive directional indicator to be above the ADX. We did get the close above 75 the next day, closing at 75.23. And you look here and you almost have to get a magnifying glass out, but you can see that the positive directional indicator is slightly above the ADX. So those two things did occur. So that was an entry as defined by what we said last week. So that would have looked pretty good. And then a nice move higher, but then today. And so after a couple nice days of gains, give it all away in one day. The old stairway up and elevator down that the market does. Don't like the fact that, it got a little vertical there. So a little bit of move back into this consolidation is not concerning, but gosh, you hate to see those big bar days there. And then we look at volume and well above average volume. That's concerning. So the way I would handle this one, if you're following it, is although we got off to a really good start, that 70 level there. If we break that, we're almost certainly coming down to fill this gap. And we're so close to it now that I think you watch 70. If it breaks below 70, then you're out of that one too. Take that one as another small loss and just get out. Look great until today on both Home Depot and Rock, both on Friday. Nice positions, and they both got reversed in today's trade. So let's keep an eye on that. So we'll watch this 70 level, and perhaps we can turn and go back up. But that was a pretty ugly day today, and I think you have to be ready to pull the trigger and exit there if we can't hold ourselves here and have some sort of a more bullish day. Technically, 70 is where the breaking below 70 is where the stop would be. But when you see a day like that, you're suspicious that there's a decent chance that we continue lower and do break 70, but maybe not. Let's keep an eye on it. We're close enough. The low was 71.30, so it's not that much further. So let's keep an eye on that and see what happens. All right, now let's see what we can find for today. And we have one on the bullish side and one on the corrective side. Here we have Cathay General Bancorp, which, as you can see, had a really nice day today. And we look at the Elliott Wave pattern, and because we moved above 100%, we didn't have to come down to the previous 4. You're supposed to come down to 61.8, and look where we came. You see why we talk about this Elliott Wave stuff? Look at that. When the wave 5 goes above 100%, you don't look for a correction to the wave 4, you look for a 61.8% correction. It's exactly what it did, and now it's turned back to the upside. Now it's a little bit overbought right now, so that's a concern. And then we get back into, okay, we're a little overbought. Look at volume, huge volume spike. Don't know what the news was on this today, but something. Well, was it earnings? No, it wasn't earnings. So not sure what the news was that created that big volume spike up here. But now we're so close to this previous wave 5. I don't know how you chase this right now. I feel like, a little bit of backing and filling here. We have some resistance there at 39. Keep an eye on this one. And if we break above 39 after we consolidate here a bit and let the 10-day moving average catch up and then break through 39, I think you've got a really good trade here. And we're probably looking at maybe threatening that move all the way up to 45. But just to be clear, not tomorrow. We need to see how we handle this 39 level. And you don't have to have a down day tomorrow, but I'd like to see some sideways stuff and let that 10-day moving average catch up. That's what I would prefer to see happen tomorrow to jump into this one. So that's one to keep an eye on. So we can put that on a watch list. CATY on a break above 39. I just hope it doesn't do it tomorrow, because if it breaks above it in an already overbought state, you know the rules, it's likely not going to hold. It'll probably turn and come back down. So let's see if we can go sideways and consolidate and then move from there. So let's see what we have on the corrective side. DVA, and that's pretty ugly day with that move lower. And you can see where the target is. So we had all the moving averages all together. Breaking below 100 was key. So if you see weakness tomorrow, where it looks like we're going to continue down, it's not a huge move here, but it should come to that previous 4, which brings us to, what was that low? Just under 92. So 92 would be the target. So let's look at that and let that be our case study, official case study for tonight is DVA moving down to 92. So that one on that kind of a break and above average volume without having one of these crazy spikes. So just while I'm here, see, this is what I'm talking about. This big gap up here on this massive volume spike. So what happens? It comes right back down, and you wonder, well, why does that happen? You get a big gap up on a huge volume spike, and what happens is you exhaust for a period of time the buyers, and then it takes a while to consolidate that. And that's why you have some give back and some sideways move, and then took off again. And it hasn't held and moving back down. So I think we're looking for DVA back down to 92. So Zach, absolutely dead spot on time. I'll take some questions.
Well done there, sir. And yeah, it's great to be back. I missed out on all of this fun last Tuesday, but happy to be back here. I heard that you had run away from the storm, even though you're a local Floridian. Is that true?
I did, yeah. But you saw what I was looking at, so
yeah, it looks like it was worth it. And you're probably, well, you are a smarter man than me, so I weathered it here. But luckily, this wasn't too bad of an area. But anyhow,
I'm glad to hear that, and thoughts with those that weren't as fortunate on the drive back from the cabin I certainly saw in North Florida. A heck of a lot of trees down, billboards are down, the signs were twisted. So there's some areas I'm sure that that felt the brunt of it. I'm glad you didn't. But
Yeah, no,
yeah,
I appreciate that. And again, I second that thoughts with anyone that was on that West Coast. It was pretty heavy over there. So let's go ahead and start out with coin. We can't go a session without coin, right?
no, not anymore. And I didn't even look at Bitcoin. So let me bring that up when we look at it, because we kind of do those together now. And that was a nice move back to the upside, considering what's going on with Bitcoin, but they couldn't hold it. So we got back above 80, which looked really promising. And now we're back just slightly below it again. And we got to hold 70 here on coin. So we've got some room, closing at 77.50. But that 70 level that held with the wave 4 here needs to hold again. Look promising with the break back above 80. But yeah, I think this is the problem, is Bitcoin wasn't being helpful. So we had the big spike up, and then it's come back down, and Coinbase has just followed right along with the script. And I think that's the way this is going to play out, as goes Bitcoin now. So goes Coinbase. At least that's the way it looks right now. And Bitcoin is perilous. Yeah, it's back to my analogy of the fingernails holding on a cliff. You can see that if we can't stay above 25,000, then yikes, where do we go? And some of you might say, well, where's the 61.8% corrective level? Since we just saw how well that works, and that would be a great question. And so let's take a look, and that shows right down here at what, 24,273 is where the 61.8% correction would be, because that wave 5 moved above 100%. So you're not looking down here at 20,000, but perhaps maybe a little bit lower from here. It would be more bullish to go ahead and hold here. It's at the 50% corrective level. It's trying to hold here, and it gave a little bounce, but then back down. So I'm just saying that we could go a little lower, and then you would really want to see it hold the 61.8% level. Slightly more bullish if we hold 50%. So right in there, and that's kind of what we're looking at with Coinbase. We still have a qualified 5-wave to the upside pattern. So if we can hold 70 and then get back above 80, we could be looking long again. And I just think it's going to need a little help from Bitcoin for that to happen. So a little bit of no man's land here with Coinbase, but we'll see if it can hold 70.
Yes, that's one we will certainly continue to watch. So we'll go over next to PJ. This was a question back in reference to the TNX. Why were the 10, 30, and 50 EMA chosen versus using Fib MA such as 8, 34, 55?
Yeah, that's a good question, because I set a lot of my settings on my indicators on Fib levels. I did use the because you go, 1, 1, 2, 3, 5, 8, 13. So I experimented with looking at an 8-day moving average, a 13-day moving average, and with the 10-day moving average, it's so widely viewed. It's kind of, you look at it because that's where all the machines are programmed with all the machine trading. That's a very good question though, on why not 8 or 13 instead of 10. And I tried it for a while, and there's some success with the 8-day moving average, maybe giving you a little bit of a look ahead of what was going to occur on the 10-day. But it's just the adage of seeing, what all the rest of the traders are looking at, and you kind of got to know what they're doing. And so that's the reason why. But what a great question.
Agreed. And just two things I want to point out real quickly before getting to the next question. We are going to be resuming TradeFinder, not next week, but the following week, as in we will not be hosting TradeFinder on Tuesday of September 12th. So just a reminder, there will be more sent out around that as well, but just wanted to send a general reminder now. I also see that we have 2 hands up in our attendees list there. And as much as we would love to hear your voice this session, we unfortunately just don't have enough time in this session for voice questions, but we encourage those in the insiders meeting, again, where Rob and Jeff have a 45-minute Q&A portion and can have your conversations then. So please feel encouraged to raise that hand if you still have the question on Thursday. We're going to go over to NVO for JJ.
NVO, and this one has shown up on the search a couple of times, so perhaps that was noticed. And man, you get the vertical move up, and it gave some back, but not much. We got back near the 10-day moving average, and we've held in there pretty well. I think this one is just, it's kind of nervous time. Very strong wave 3, obviously a massive move to the upside there. We had big volume, and so there was the give back. We ran out of buyers for a bit, and we've gone sideways since, but it is trying to get above that 190 level, and we opened above it, closed right on it. And if we can close above 190 with a follow-through day, then yeah, I think we're going to that wave 5 target above 200, and then we have to wait and see. That looks very doable, even with this big gap to the upside here. If you're wondering about, I don't know if the question is person looking long or short, but I wouldn't be looking for filling that gap anytime soon with this kind of a move. So one day that will happen, or is likely to happen. But for now, it looks more like 200 is in the picture if we can get above 190 with follow through. So little pullback. We've tested the 10-day moving average. We've held it. We tried to get above 190 today and closed right on it, 190.11. So let's see what we can do tomorrow if we can break above that. And then I do think you see probably 205, and then we have to revisit it and see if there's enough momentum left. But pretty darn impressive the way it's handled that big, huge gap to the upside there.
Agreed. And Rob, sorry, I know you already covered USO, but Angel's got a question here that I think is interesting and would might add value to others out there that might be wondering about what's going on with USO. In light of Saudi cutting out output till the end of the year and US filling the petroleum reserve, will oil force the hand of the Fed to contain inflation and raise in September and once again in late October, making bloody Halloween? Thoughts?
Possibly. And when you have oil running like this and energy all moving up, it's gonna make those inflation numbers certainly not come down near that 2% that they're looking for. So the inflationary numbers are probably gonna reflect this, as you said, Angel. I think you're right there. I think September is off the table. I don't think they go in September. Where the Fed Fund futures is playing around with November. It was at 50-50 and then it backed off, and then now it's pricing it back in. Perhaps I just don't think September. I don't think it goes that fast, but I think they're pretty committed, unless the numbers are really looks like inflation is accelerating again. And I don't think there's enough offsetting the increase in energy, but it is worrisome. And you're right, it could lead to more Fed rate hikes. Your bloody Halloween could be true. I mean, that could come to fruition. They could be raising rates then and surprise people. I don't think September, but after that, all bets are off. I think.
Yeah. I like the play on words there, Angel. Yeah. That was clever. And so let's go over to Zoom for our friend Will.
Are you gonna tell me what he wants to look at, or
did I cut out Zoom?
We just say hi, Will. Is that the?
Yeah, we can just talk to Will. I mean, if
Will, how you doing? glad you're watching.
I said Zoom for Will. Maybe I cut out.
Oh, I thought you said he was on Zoom. That's my bad. Okay. Uh, the stock Zoom. Okay. So my fault. Looking here and, you know, remember when it was at 500 and everybody was trading this and it was a crazy time during COVID and, it just was off to the insane races. And now it's grabbing a bit again and kind of go, why? We couldn't hold the break above 75, but that's okay because it was too overbought. It wouldn't have held anyway. But the fact that we're testing 75 and perhaps we go sideways here for a couple of days, let that 10-day moving average catch up. But I think if you see Zoom get above 75, it's a good long. I think it takes off again and maybe goes to at least 85. So yeah, that's pretty impressive what it's done over the past few days. And you kind of wonder what's going on there as well, I think. But yeah, so let's see if we can close above 75, have a little follow through, and then I think we have a move to 85. But right now, it tried it today. It's a bit overbought, and the ideal scenario is a little bit of sideways movement. Let the 10-day moving average catch up, and then break above 75 and run. But that's another really good one to keep an eye on. So yeah, that was a good one, Will.
Yes, indeed. Yes, indeed. All right, let's go over to Pankaj joined our chat here and would like to look at SU.
Good old Pankaj. How you doing, sir? And nice to hear you on a Tuesday night. And yeah, so as we said earlier, the energy is the place to be in the U.S. right now. And that's a heck of a move to the upside. And, Suncor was, gosh, that was a fun one to trade in the past. So a little bit of a blast from the past for me there. And we're tiny bit overbought. And I don't, Pankaj, if you got part of this move, congratulations. But as far as right now, we got to see it break above 35. And if it does, then we could really have something going there. And I don't know that, I just feel like oil needs to rest and perhaps pull back a bit, but I don't know that the end of the move in oil is here. Oil could continue higher. It's just too overbought right now. And so, that's going to affect everything energy wise. But that looks pretty impressive right there. I just want to see it get above 35. And it's a little tiny bit overbought, but not a whole lot. So break above 35 with follow through. And yeah, that could be a really good one too, because that's a great looking move so far. So I think you got a good one there, Pankaj.
Agreed. Let's go over to QSR for Teresia. I hope I pronounced that correctly.
Restaurant brands. Are people, we still going to go out to eat? I don't know. With the credit card data and everything, I don't know how much the consumer has left to spend, but breaking below 70 is problematic here. You can see that we broke below it, went back up. Now that's a really strong wave forward there, 61%. So we're at the 61.8% level. So that moving back up above 70, you would have thought, okay, that looks pretty good. But then you had Thursday closing on the low, Friday closing on the low, and then today breaking back below 70. So there wasn't a lot of, it tried and, had good intraday movements at the end of last week, but the closes were pretty ugly. And then back down here. So you got to pay attention to that 61.8% level. So as long as we can hold that low there off from the 29th, perhaps we gather ourselves and try to get back above 70. But those two end of the week days last week and then today are kind of ugly. And we'll see if it breaks below this level, it might be a good short. So 70 is the key. We want to see a break back above 70, a close above 70 with follow through. And then you could even be aggressive above the 50-day, before the 50-day moving average, if that could occur, because that's such a strong fib level. If you're a bit more conservative, you want it above 70 and above the 50-day moving average, and then you're likely off to the races on this wave 5. But today, Thursday and Friday and today, 3 troublesome days in a row here. And we just got to watch this and see if we can hold this wave 4 low at that 61.8% fib level. Otherwise, if it gives that up, then what happens is it retraces this big wave 3 impulse, and now you're looking all the way back down here to 60. Now we're not there yet, but if we give up that 4 and disqualify this pattern, that's what usually occurs. So let's see what happens with 70.
Yes, indeed. And all right, another awesome presentation, Rob. Thank you for that. And I see we are 2 minutes after the hour, so I think I have a good fundamental question to wrap up the session with you. And I do want to say real quickly before, Will was nice enough to put in that chat to hit that like button. So I'd like to second that or echo that. Please do smash that like button for Rob. It goes a long way for us. And we always appreciate your support. So the finishing question for this session.
Well, appreciate it.
Yep, absolutely. So when you say September is a bad month of the markets, do you mean it's historically more bearish, or there's just not a lot of action in general?
It's historically more bearish. So the two problem months historically are May and September. And so you come out of the normally summer doldrums and oftentimes get a bit of a correction in September, and then we start the positive seasonality, which is October through April. And so you have, after the first of the year, people are funding IRAs, 401ks, taxes, etc. Then you get past April 15th, tax day. And so all that flood of money that's going in to fund those retirement programs dries up, and May tends to be a quieter month. But as just historical averages, the 2 worst performing months of the market historically are September and May. And normally it means correction, not necessarily just sideways. So usually you have corrections in those 2 months. So, but as I said, nothing's 100%. But yeah, thanks for asking that, Zach, for clarification there. And thanks, everybody. Good to have you back, Zach. And we will see what happens over the next couple of days. Obviously, we have a lot to watch with where all these charts are. We could break either direction at this point with decent patterns. So it's going to be fun to watch. So again, we appreciate your time. Thank you so much for spending some of your evening with us, and I look forward to talking to you again soon.